In this video, we're going to discuss whether Altria is a buy at current prices. Before we begin, I invite you to subscribe to this channel and like this video, which will help more people discover SureDividend's investor education efforts. With that out of the way, let's dig into Altria stock. Let's start by talking about Altria's business model. Altria Group is a tobacco products giant that was founded by Philip Morris in 1847. Today, it is a consumer staples giant. It sells the Marlboro cigarette brand in the US and a number of other non-smokable brands, including Skoal, Copenhagen, and the St. Michel brand of wine. Altria also has a 10% ownership stake in global beer giant Anheuser Busch InBev. Its core tobacco business holds the flagship Marlboro cigarette brand. On April 25, 2019, Altria reported first quarter earnings that fell short of analyst expectations. Revenue declined by 6% year over year to $4.39 billion, missing expectations by $210 million. Adjusted earnings per share, meanwhile, came in at 90 cents, missing expectations by 3 cents. These declines were in large part driven by a steep 14.3% year-over-year decline in cigarette volume, overwhelming the 1.1% growth seen in cigar volume. The company lowered its full-year midpoint earnings per share guidance to $4.21 from $4.22, which is now in line with our expectations as well, as the company expects full-year total domestic cigarette volume to decline by 4 to 5%. Looking ahead, Altria has a positive growth outlook, although it does face a significant headwind in the years ahead due to the declining U.S. smoking rate. Management expects about 4.5% long-term annual volume declines, which has the market worried about the company's ability to grow its top and bottom lines at historical rates, especially given that Altria's cigarette volume underperformed the broader market in the first quarter. In response to this troubling consumer trend, Altria has invested heavily in new products that appeal to changing consumer preferences. Altria recently announced a $1.8 billion investment in Canadian marijuana producer Cronos Group, purchasing a 45% equity stake in the company, as well as a warrant to acquire an additional 10% ownership interest in Cronos Group at a price of 19 Canadian dollars per share, exercisable over 4 years from the closing date. Altria will help Cronos accelerate its research and development capabilities. Separately, Altria announced it will invest $12.8 billion in e-vapor manufacturer Juul Labs for a 35% equity stake in the company, valuing Juul at $38 billion. It appears likely from the Juul investment that Altria will discontinue its own e-cigarette brand Mark 10. Altria also recently announced a cost-cutting program designed to reduce annual expenses by $500 to $600 million. It is also important to remember that Altria has faced numerous growth challenges over its long history, as U.S. smoking rates have been declining for the past 6 decades, and the company endured a massive lawsuit along with its peers in the 1990s, and taxes and regulations have increasingly grown on its products. Through it all, its premium brands such as Marlboro have remained resilient and continue to enable the company to achieve strong returns on invested capital. The brand remains strong today, given the stable market share the company has enjoyed over the last 2 years and lower than average quit rates. As a result, Altria has generated steady earnings and dividend growth for many years in the face of these challenges. In addition to the unshakable customer addiction enjoyed by its premium brands, Altria has competitive advantages that stem from high barriers to entry thanks to its business network relationships, regulatory know-how, and economies of scale. Another quality that Altria has going for it is the fact that it is highly resistant to recessions. Cigarette and alcohol sales fare very well during recessions, which keeps Altria's strong profitability and dividend growth intact. In reality, then, Altria's business model is not dependent on growing cigarette usage rates in the United States, but rather in its pricing power through all economic cycles while simultaneously improving efficiencies. As a result, its margin gains are able to outpace its shrinking volumes, thereby driving up revenue and earnings. The good news is that here in the US, cigarettes remain one of the most affordable at current price to hourly wage ratios. Therefore, when combined with the stickiness of their products, they have a good runway for continuing to increase prices for years to come without risking losing their customers. Furthermore, as production and agricultural efficiencies continue to improve exponentially due to improvements in technology, costs should continue to decline as well. Altria is not a one-trick pony either. Its chewing tobacco division, led by its wildly popular Copenhagen brand, has seen strong results of late. Over the last 2 years, revenue has grown 5% thanks to strong pricing power, which showed itself in 8% income growth over the past year in this sector. Altria's market share in this business has increased from 25% to 35% over the last decade, making it a dominant player in the industry. The company's investments in vaping are also expected to fuel growth and help offset challenges to its cigarettes business. Its recent acquisition of Juul puts it in a position to do that as the brand remains a dominant position in the US market, reporting 175% growth in liquid pod shipments in the first quarter of this year, increasing its market share to 43% while also growing its presence in 9 other countries, including Canada and 8,500 stores across France, Germany, Italy, and Switzerland. Juul plans to test several products in limited international markets this year, including a next-generation, Bluetooth-enabled device testing a variety of features including user-level access restrictions. If this robust and international growth continues, the vaping sector could begin contributing a substantial amount towards the company growth rate within a half-decade or less. Given these factors, we believe that Altria can continue to grow its earnings per share at a 4% annual clip over the next half-decade, which is conservative relative to management's midpoint expectation for this year of 5.5% growth and 8% annually over the long term. With this growth outlook, we believe that Altria is attractively priced at its current price-to-earnings ratio of 12.7. While its 10-year average price-to-earnings multiple is 16.2, the company's current growth challenges warrant a slight discount to its historical averages. Therefore, we believe 15 times earnings is a fair value for Altria shares. If this value were reached within half a decade, we can expect to see a 3.4% annual tailwind to total returns based on an expanding valuation multiple. In addition, our 4% expected annual earnings per share growth for the company over the next 5 years, fueled by continued strong performance in chewing tobacco and vaping, as well as gradual margin expansion in the shrinking cigarettes business, should increase its share price accordingly. Finally, with a high dividend yield of 6%, we expect total returns of 13.4% per year over the next 5 years, a very attractive figure for a recession-resistant stock in a late-cycle economy. However, despite the attractive valuation, there are several risks to keep in mind in addition to the declining demand in the cigarette industry. Management took on heavy leverage and considerable risk of value destruction with its ambitious $12.8 billion investment in Juul, which valued the company at a sky-high sum of $38 billion. For context, this is 40 times sales and 150 times EBITDA, and only a few months earlier, other investors bought stakes in the company that gave it a valuation of less than $19 billion. As a result, this gives a very narrow margin of safety for the investment, creating value for shareholders, and makes management's long-term international expansion and profitability targets appear quite ambitious. Furthermore, while the heavy debt burden from this investment does not threaten the dividend at present, it could if the cigarette business continues to flounder and the Juul investment does not pan out as expected. The company has also spent over $1 billion on share repurchases since 2012, with a lot of that money spent at share prices higher than today's. Therefore, management has once again shown that it is not the most skilled capital allocator with retained earnings, which is something investors need to keep in mind when evaluating the current valuation. Investors also need to be wary of regulatory risk. While the company has weathered this challenge successfully over the decades, and the current environment does not appear particularly threatening, it is still a factor that needs to be taken into account. In particular, any attempts to regulate advertising could reduce the strength of the company's brand-driven moat, which could prove to be very detrimental to results. Another regulatory risk is that the company could be forced to reduce the use of addictive substances in its products, such as menthol and nicotine. This, in turn, would reduce their stickiness, also negatively impacting results. Another risk that many may not think of is gas prices. Since many cigarettes in the US are purchased at gas stations, the higher the gas prices, the less drivers are likely to spend extra on cigarettes. Altria's management even includes the gas price as a slide on their company presentations, and have blamed elevated gas prices in the US during Q1 of this year for the reduced full-year guidance. Finally, litigation is a risk as evidenced by the over $200 billion lawsuit brought against the tobacco industry in the 1990s. In conclusion, despite its numerous risks, we view Altria as a buy at current prices for the following reasons. First, the strength of the company's moat in its core cigarette business, and the relative affordability of cigarettes in the US, should enable it to continue to grow its margins at a rate which should largely offset volumes declines, if not lead to organic growth in the business. Second, the company is no longer a pure play on cigarettes, thanks to its stake in beer company Anheuser Busch InBev, the wine business, and growing cannabis, smokeless tobacco, and vaping businesses. These businesses should also help keep the company growing its revenues, earnings, and dividends for years to come. Third, Altria is very recession resistant. Given that we are already in a record-long expansion, the next recession is likely to come sooner rather than later. As a result, highly defensive stocks like Altria should carry a premium at times like this. Fourth, Despite taking on considerable additional leverage to finance its Juul acquisition, the balance sheet remains investment grade. The company enjoys a very low cost of capital, recently issuing $16.3 billion of debt at a weighted average coupon rate of 4.1%, while maintaining an overall weighted average coupon of less than 4%. The company also generates $1 billion annually in excess cash with which it can pay down debt, grow its dividend, or buy back shares, any of which would be a positive development for investors. Additionally, its 2.5 times debt to EBITDA ratio is among the lowest leverage ratios in the tobacco industry, meaning that it is not over-leveraged and could probably take on even more if need be. Fifth, management remains very excited about the opportunity to market Philip Morris International's IQOS Heat Not Burn product in the US, after the FDA approved the sale of this product in a long-awaited decision. Altria will market and distribute IQOS in the US on behalf of PMI, and will share revenue generated from IQOS sales with their international peer at undisclosed proportions. The product will also be regulated as a tobacco product, giving it additional barriers to entry, which is a very positive development for the company. This will add an additional badly needed growth tailwind for the company to offset its slumping cigarette volumes. Finally, Altria's valuation is very attractive. Even with a conservative assumption of just 4% annual earnings per share growth, that is well below management's long-term 8% growth guidance, and an assumed fair value that is less than the company's 10-year average price to earnings multiple, Altria is poised to deliver double-digit total returns. Furthermore, its 6% dividend yield is not only attractive and well covered in its own right, but it is backed by half a century of consistently growing across a wide variety of economic cycles. The stock is especially attractive for conservative income investors due to its well-covered high yield and recession-resistant business model. Thank you for watching this video, which performed a deep dive into Altria stock. We invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website at www.suredividend.com.